Welcome to this episode number 62 of Your Next Trade. Call today, correlation is back. So we had a week with a lot of moves. Today we're going to be covering many subjects from semiconductors to inflation to risk on, risk off. So as always, I would like to start with something that is pretty interesting. I'm looking at the correlation between bonds and stocks. So we do know that since 2021, we have inflation that has been pretty aggressive in the world, and the following effect has been for yields to go higher and bonds selling off. So if you are a normal investor, what you will do normally is you're going to have both stocks and bonds in your portfolio. But more importantly, when there is some risk off in the market, you will be going to fly to haven, and you will be fly to safety, should I say. And this is about, buying bonds. So you'll be buying your bonds. But what happens is when you do have inflation, as we have since 2021, that is a different story, because inflation means, yields going higher, bonds going lower. So you can't be protecting your portfolio like you will be doing normally. And when I say normally, this is probably what we've done between the 1980s to 2020, roughly. So for 30, 40 years, it was pretty easy. Risk off was meant you were buying bonds. Last year in 2023, between the summer and the end of October, what we had is yields went higher. And in the meantime, stocks were suffering. So we had a big correlation between stocks and bonds. From November to the start of March, or roughly the mid-March, this correlation was not the same. So stocks did very well. So we had a massive rally in risk on in stocks, where stocks went from 4,100 on the S&P to 5,200. So roughly 25% for the S&P. And in the meantime, the correlation between bonds and stocks was not present. So here I'm interested into this chart, where on the left hand side we do have like the S&P. So S&P will be in blue. So this is your line in blue, and in white this is for the right hand side. This is the bonds. This is the US 10 years through the futures. And as you can see, more recently, if you look since the end of March, actually bonds through the yields. So yields went from on the 10 years for 375, that was I think at the end of December, to 460 this week, 470. So bonds, when yields are going higher, bonds are going lower. As we can see, this is the Y chart. And we had a catch up from the left hand side, which is your blue line, which is the S&P. So the correlation these days between bonds and stocks are pretty much like one, whereas most of the time, as I say, between the 90s and 2020, they will be uncorrelated. So what does it mean for you as an investor? That means first that as we have inflation, and now that the market is pricing a second wave of inflation, yields are going higher, and that puts some pressure on stocks. But that means as well, if you are looking to protect your portfolio through some hedging, it is much harder. You can't be going for the usual bond. So where are you going to be putting your money? You do gold, as we saw, gold breakout from the 2080 level and went on the tier. Same with silver. You'll be buying a bit of crypto if you're allowed to your mandate, and if you're keen on protecting your portfolio. But other than that, the protections are pretty limited. So what you do in situations like this is, as the volatility is going higher, you need to reduce your exposure. You need to degross your overall exposure. So if you got 100 million long and 100 million short, let's say if you are long short, then you're going to be going 80 million versus 80 million. So your gross exposure is going to come down. And if you look at what has been happening this week, a lot of explanation can be explained by this degrossing of the overall portfolio. So let's start with the year-to-date asset performance, where now the S&P is only up 4%, Nasdaq 2%. We got Europe still up 8%, something. The Japan is up 11%. But as always, you need to adjust all those metrics, all those returns with the through the eyes of the of the FX. Why? Because, if you look at the euro, for example, for the year, it's down 3.5%. So adjusted, that gives you a 5% roughly for Europe up on the year. If you look at the Japan, so 10.8% versus your minus 8.8, that gives you roughly Japan up 2%. So overall stocks, depending where you are, it's more or less the same between Europe, US, and Japan. We are now talking between 1 to 5%. As you can see, dollar is pretty strong for the year, between 3 to 9%. Crypto still very strong, 50% for Bitcoin. Here I'm interested in those three commodities. And this is quite a big signal when the commodities, we are talking gold, WTI, and copper, are actually moving exactly the same. We are talking 16%. So it's not about being magic. It's because, people, investors are allocating money through the different asset classes. And those asset classes, we are talking real assets, we are talking commodities, have been doing pretty much the same outperformance, around 16% for those three. So what about going into the next one, which is your week to date? So this is a pure risk off for the equity market. We are talking minus 5.5% for the Nasdaq, minus 3% for the S&P, roughly the same for Russell. Japan down 6%. So overall, stocks selling off quite big time. So that has been the worst week for the S&P and for the Nasdaq, I think, since October 2023. So very bad week overall for the US dollar. Flattish, I will say, a bit of risk off as well for the crypto, but not that much. If you think about, let's say the beta that crypto used to have, it has been doing pretty well for the week. It's down like the Nasdaq, where you could have assumed long time ago, not so long time ago, like crypto will have been done much more than that. Gold 2%, minus 3% for WTI, and copper that breakout. So this is the one to be looking at. But as we said just before, all those three commodities have been down up 16%. So year-to-date industry performance, the S&P is still around here. You don't have that many sectors or industries that are outperforming for the year. But let's jump into the week to date. What have been the losers of this week? Semiconductors, technology, solar, Nasdaq. So semiconductors, technology, and Nasdaq will have been the outperformers for the year. So really, it has been risk off, reversion to the mean. S&P is around here. So you can see that S&P actually, you do have like it's almost in between in terms of average returns and putting the money. I'm interested more into the sector performance. As you can see here, you do have like financials, utilities, and consumer staples that have been outperforming the market and up for the week. So it's a pure risk-off week where you go for safety with utilities and consumer staples, despite rates going higher. So what is interesting is if you look at the banks, actually on Friday, Wells Fargo was up, Bank of America was up 3%. So that means rates are going to stay higher for longer, that the market is pricing the Fed to be keeping rates much higher. If you think that the sell-off is mostly about, risk on the economy, I don't think that is the case, because when the market goes into the recession phase, normally banks will be in trouble. And this week they have not been. So it's mostly about market pricing higher for longer and rates staying at this level for quite a long time. Technology minus 6%, real estate, consumer discretionary down 4%. What about the rates? So US 10 years at 462. You remember or not that not so long ago the trading range was between 375 and 420. We went above. We are now 30 to 40 bips above. Why? Because in between we had inflation. So we had higher CPI in the months of January, February, and March. So 3 months don't make a trend, but it's obviously much more than the 1 month. So we went for a very accommodative Fed and expectations. So looking at the Fed fund rates in December 2023, market was expecting the Fed to be quite accommodative for the year to now. What are the expectations looking at December 2024? We are looking at 499. So 1.5 cut in 2024. So what does it tell you? We are far away from the 3 dots that we had from the Fed, which means that the market is now pricing a much more hawkish Fed. We're gonna have the FOMC meeting at the end of this month, start of May. We'll see what are going to be the comments. I think there is a bit more hawkishness in those data, but overall, if we look at commodities, if we look at bonds, if we look at the dollar, that tells you that the market is pricing higher for longer, and that has a huge impact for stocks. What about the VIX? So VIX 18.7% as of yesterday. We went above 20%. As you can see, there has been a pressure where the near future contracts, the May and Junes, have been below the spot. So that tells you that there is a spike in the volatility and a bit of fear. More recently, here this is about the elections coming. So now let's jump into the technical analysis, and I'm going to be switching from logarithmic to regular. So big week. If we look at the weekly on the S&P, we're at 55,000 on the futures. But we mentioned something very important last week, that and I'm going to switch into SPX here. That was, we said that many CTAs, which are looking at trends, will be flipping their position around 51.20. Okay, and what happened? I think it was Monday and Tuesday when we started to trade below 51.20. We started to see big volumes on the downside, and over the week we carry on. What does it tell you? It tells you that CTAs, that funds that are looking at trends, have been selling and degrossing. So they used to be very, very much long only and quite like heavily invested. We are talking 95% plus. And the trigger to reduce the exposure at 51.20. I think another important level for the cash would be 48.60, 48.50. So overall, the whole week has been about degrossing the exposure. Going back into the Nasdaq, this is the first level that you can have. I think the second one is probably 2 or 3% below, but the trend that started in November is clearly broken. So this is it, the massive trade. So we do have like a different market. I'm interested into the fabulous 7 of this world, that we're holding the market, holding and holding. It didn't this week. Why? Because, NVIDIA of this world has been really struggling. So NVIDIA down 10% on Friday. You probably saw SMCI, which was another. So let's put an SMCI up. SMCI. Okay, this is the one. So down 15% plus on Friday. Why? Because just before the open, what did they say? That they said that they're going to release their numbers at the end of this month, but they did not pre-announce and did not, like they did in February, saying that their numbers will be better than what was the consensus. So that tells you a lot about the expectations. If those companies are not changing their expectations, they'll be down. They have been down 15%. So expectations were really, really high in this industry, semiconductors, but there is still a long way to go. If you look at those charts, just to reverse to the mean, if we look at things like the 200-day moving average. What about oil? So oil, I wanted to underline oil last week because obviously we do have like some tensions in the Middle East. But I don't think this is as important as some, retail traders or some market participants will say. This is, unfortunately, that this is important for the region, but for the market that is so far less important. Otherwise, you'll see oil at a much higher level. Copper, that is really the one that has been moving, and I want to do a weekly chart here. You see these big moves that we had over the last 3 weeks. JP Morgan holding pretty well for the week, so up on the week, and this is a sign that the market is pricing higher for longer. So I want to jump now into what has been happening this week and what we flagged last weekend. So last weekend we flagged many things. We flagged the earnings season. So let's start with the earnings season, and this is the chart that is here, and I'm looking at the price action on earnings day because I want to understand as an investor, as a trader, how the market is behaving on earnings. So far, price action stocks have been roughly down 1% on the day, and as you can see, only this airline has been doing very well on the day, up 17%, but roughly, most of the stocks will be on average down on the day. Why? Because the numbers, they are okayish, nothing fantastic. So those numbers, they are coming from Refinitiv. EPS on average 74% beat with a 7.8% above estimate, which is versus your history that is at 74 and 6.7 over 10 years. This is roughly the numbers that you have. But if you look at revenues are beating 58% of the time, which is below the average 10 years and below the beat of 1.4% on average. So to me, in the long run, revenues matter a lot. You can be playing with EPS, but you can't be playing with revenues. And as we have been saying over the last few quarters, companies have been struggling to be beating the revenues. And the market, is obviously looking at those data. Next 2 weeks are going to be extremely important because this is the most busiest weeks of the next 3 months. We're going to have plenty of names, as we're going to see in the next step. So earnings season so far, both the reaction and actually the numbers that have been produced are, let's say, just average to below average. What about retail sales that we flagged? So this is the US consumer. I've been wrong. I've been saying that for the last 6 months. It is about, looking at the balance sheet of the US consumer and how the US consumer might be depleting their reserves that were built after COVID. So far, the core retail sales for the last 2 quarters have been pretty good. So core retail sales in March was up 1% for the months-on-months and almost 5% year-on-year. So pretty good numbers from the retails. As I said, next one was the CTA, and to me that was one of the most important data to be looking at. And here, this is why I put the chart of the S&P 500 over the last 5 sessions. And this is your 5120 that we flagged last weekend, and this is where we started to sell. Why? Because this is an automatic level. When those funds will be following trends, they have levels that could be something like for you, like your moving average 10 days, 20 days, 50 days, and you will say, if it goes below this level, I'm going to be reducing my exposure. And for the whole week, that has been the trend. So it's almost like a VWAP order. We sell, we sell, we sell. So it's a flow market. It's a selling flow that we had. We had the VIX expiry on Wednesday and the OPEX on Friday, so a bit of volume, but and what we had over time is actually OPEX week has not been a great week for the overall market. And obviously we had the Middle East noise, especially between Thursday and Friday overnight, where the S&P futures were down 2%. They opened almost flattish to finish down 1%. So higher volatility, market is pricing as well, inflation higher for longer, and that has been detrimental for stocks more recently. So looking into the next catalyst, obviously what I'm interested is if stocks are mostly following where is my 10 years. I want to know where is going to be the 10 years going next and what could be impacting my 10 years. So first thing that could be impacting my 10 years, this is the macroeconomic. Okay, so this is your PCE on Friday for inflation. This is your GDP on Thursday. And this is as well on Friday, personal spending and personal income. So you don't want to see very hot numbers because that means inflation you're going to have the second wave on inflation and yields are going to stay there for long. Similarly, flash PMIs on Tuesday. I don't think the market wants to have an economy that is too hot. This is not about soft landing or landing. This is, you don't want to have like crazy numbers. For the bonds as well, I'm really much interested into the bond auction. So we do know that the US government, the US are running a 5 to 7% deficit. When you're running a deficit, as I said before, you need, you need to go to your banker and you need to borrow money. So what is happening is the US economy is borrowing bonds, is borrowing money, and they need every month, every quarter to borrow tons of money. Okay, so if you do 5 to 7% of several trillions of your economy, that means you need to ask different investors to give you some money. And what we have for this week, we have on Tuesday, we get 69 billion borrowed for the 2 years, 70 billion on Wednesday, Thursday we get 44 billion. So overall, we are talking roughly 180 billion. That is a significant number. And that's when you have a lot of supply that is putting pressure on the yields. Why? Because investors are asking, decent yield to make sure that it makes sense for them. So what about the Fed speakers? Not much for this week. The Fed blackout period is starting today on Saturday. Why? Because in 10 days' time, we get the FOMC meeting. Normally, no changes, but, it is going to be about the comments. So next numbers, as I said, inflation, this is your PCE. PCE is the CPI for more advanced, and the CPI that the Fed is looking at. More recently, the moves on PCE days have been quite muted. But before that, when we had more inflation, that was the moves were much higher. So if we believe that we have a second wave on inflation, and I think many economists actually expecting PCE to be okay based on different calculation where the CPI was higher. If we have a higher number, then we are looking for trouble. So Fed, FOMC, in 10 days, bond supply, CTA. So I'm interested still like we did last weekend, if we are going to have more degrossing and more trend followers selling, I'm looking at the flash PMIs, GDP, PCE, and obviously I'm looking at earnings. So earnings, this is for this column. We are looking at for the S&P roughly 20% of the number of S&P companies. That gives you 20% roughly of the value. We do have many names by sectors and by industry. So as always, if you own long or short names, you should be looking at those leaders. So we have SAP in Europe, you get Nucor for this sector, then we're going to have Tesla, we get GM. Every single day you're going to have big names. Boeing, you're going to have Meta. Obviously, one of the biggest days is going to be Thursday. We got Microsoft, we got Alphabet, we got Intel. So really massive day. And the day after, this is almost like the XLE day with ExxonMobil. So many names coming. As I said, so far the earnings season, both the price action and the numbers that have been released have not been great. I've been flagging like we were changing a bit the market conditions over the last 2 to 3 weeks. Why? Because the correlation between stocks and bonds were getting closer to the level that we had 6 months ago. And as long as yields are going higher, meaning bonds are selling off, that puts pressure on stocks. So I don't want to do too much of back trading and telling you that back trading is easy, because I don't want to create FOMO on the way up and on the way down. This is still about getting a process. Hopefully you can get that with the 4x4 video series and or the mentoring. This is what I've been doing during this presentation is more or less what you learn to do with those two products. If you get questions, you can join us on the trading community on Discord, where you're going to have mostly one big channel for free users, and then you're going to have 20 channels for people that have been subscribing to the 4x4 video series. Any questions, you can send them to greg@duponttrading.com or reach me on social media, and I'll be very happy to come back to you. So again, strong correlation between bonds and stocks. Market is pricing higher for longer. Much more difficult to go for hedges and protection when bonds are selling off. So this is a bit of scratching, and mostly what people are doing in those cases, they are reducing exposure. This is it for me for this week. Lot of earnings. Have a good trading week. See you next week. Bye-bye.